just your reaction to the print that we're getting here this morning. Yes, it shows that inflation does remain maybe a bit hotter than what the Fed anticipates or would like to see at this point, but not really ringing too many alarm bells yet. Is that right?
Well, you're right. It wasn't necessarily a material increase, but this is significant for the Fed, who was expecting a sizable reversal in this disinflationary trend, which as of the start of the year now has not only arrested, but we've started to see mounting price pressures move in the opposite direction away from the Fed's 2% target. So for a Fed desperate to provide relief, this is far from the ideal conditions when we talk about rising producer, consumer, or the PCE, as we saw this morning. So this is going to complicate their outlook and potentially delay any conversation about near-term rate cuts. And I think it's going to, at the very least, put the possibility of re-engagement and further rate hikes back on the table.
You know, it's really interesting, Lindsey, especially when we pair together all of the economic data readings that we've got this morning. And we were just mentioning consumer sentiment. It seems right now consumers continuing to express uncertainty about the future trajectory of the economy pending the outcomes of things like the election. You've got exogenous threats that, of course, we never know until they happen. All of these things considered, is there any dampening of the demand environment that we're hearing about from companies right now that we see deteriorating further, or does the resiliency look like it's going to remain intact?
Well, right now, the consumer does appear to be very resilient, continuing to spend on particularly services in this environment. As we saw with this morning's number, the consumer is still spending at an annual pace up near 6%. But when we parse through some of the details, as we saw in the GDP report, consumers are being more choosy on where those dollars are being allocated. So not all businesses, not all sectors of the economy are faring equally in this environment. So that being said, broad-based growth has slowed as momentum has slowed. Consumers are still spending, but they're doing so at a noticeably slower pace. And so as a result, growth, top-line GDP, has come down from 5% to 3% at the end of the year, let's call it, to now below 2% as of the start of the year. So there are signs of fatigue, but the consumer, as the backbone of the U.S. economy, does still appear to be the strongest support to growth going forward.
And Lindsey, so that sounds like something you expect to continue here, at least for the coming quarters, if I'm understanding that correctly. So what does that then tell us just about the ultimate timing here for a rate cut, how unlikely or likely it could be here before the end of the year?
Well, I think it comes down to the performance of inflation. If inflation stabilizes at the current levels or even ticks up maybe slightly higher, I think by the end of the year, given that the Fed is desperate to provide relief, I think the committee may still be willing to give us 1 or 2 rate cuts. But without more of a meaningful decline or improvement in inflation, after that minimal concession, I think the Fed's hands are tied, and we'd likely see the Fed move back to the sidelines for a second-round extended pause. And in fact, even if inflation does revert back to a disinflationary trend, I think rate cuts from there would be very slow, very tempered, very controlled, leaving us well beyond neutral, not just beyond 2024, but well beyond 2025 as well. But the biggest risk is if inflation doesn't behave as the Fed anticipates. The biggest risk is if inflation begins to more meaningfully reverse course, not only in terms of the month-to-month increases, but on a persistent basis. At that point, I think the Fed's hands may be tied to, as I mentioned, re-engage and put the possibility of a further rate hike back on the table.
Lindsey, getting kind of a roundup of thoughts on this, has the Fed successfully initiated a soft landing yet, or is that still up for debate or up for seeing in the data coming forward?
I don't know if we've necessarily seen a soft landing, as we're still working through the cycle and price stability has yet to be achieved, but we're certainly at a soft pause or soft phase of the cycle at this point. And the Fed certainly wants to perpetuate these solid conditions in the environment, out in the economy. Again, and that's the motivation for why they want to initiate these rate cuts as soon as possible, as soon as the inflation data allows. But right now, with inflation reversing course since the start of the year, the Fed is on an unfamiliar pathway, certainly on an unexpected pathway for when that potential change in policy may come to fruition.
So, Lindsey, what does that then tell us about the expectations here, whether or not, or your confidence that we will achieve a soft landing? And if not, then what is the more realistic outlook, do you think, at this point?
Well, remember, to achieve a soft landing, the Fed has to raise rates to a sufficiently restrictive level in order to eventually reinstate price stability. But the goal was never to go from 8 to 6 to 3%, but to continue along that downward trajectory back to 2% on a sustained basis. It's not about touching 2%, but getting back to 2% and staying there for a prolonged period of time. And right now, I don't see any evidence in the inflation data that we are on a trajectory back to that level. So the Fed may be forced to re-engage in order to reach a sufficiently restrictive level in order to reinstate price stability. So the possibility of a soft landing is still out there, but I think the Fed still has a lot more work to do to ensure that we reach that mandate.
All right, Lindsey Piegza, Chief Economist for Stifel Financial. Thanks so much for joining us here this morning.
Thank you for having me.